Welcome to MyFinJourney, the show where we don't just talk about money, we challenge the very way you think about it. The reality is, most people work hard, save harder, and pray that it'll be enough. But that's not wealth. That's barely meaning survival. Today's guests believe that the financial system was designed to keep you average. They run Money Insights, manage over $500 million in assets, run a podcast, have written books, and have spoken to hundreds of high-income earners to help them transform income into generational wealth. Christian Allen and Blake Brogan aren't here to sugarcoat things. They're here to show you why the traditional finance playbook is broken, how to bounce back when life knocks you down, and what it really takes to build a legacy that outlives you. If you ever felt like the harder you work, the further freedom slips away, you're not alone, and this episode is the one you've been waiting for. Chris, Blake, welcome to MyFinJourney.
Thanks for having us on, my friend. We're excited to be here with you.
Thank you, guys. I appreciate it. So Chris, Blake, I'd really love to just dive right in. I'd love to understand, when you say a statement like the system is designed to keep us average, help me understand what that means and how you guys came to that conclusion.
Okay, so I think we believe that traditional financial planning in general is just broken. And I think the way that we know that is there's really two ways that we know it. First one is through anecdotal evidence. So I started my career in the traditional financial planning world. That's what I did. I thought I was going to go manage stocks, funds, and mutual funds for people for the rest of my life. And I did do that for about 10 years. It was in probably around 2010 that I started to transition into the alternative space. So the first thing that kind of gave me that feeling, and I'll let Blake give his take in a second, but the first thing that gave me that feeling was just I was looking at myself, meeting with people in the traditional space. I wasn't having a huge impact on where they were going. Like we weren't actually achieving the goals and objectives that we wanted to. And then I was able to kind of juxtapose that against people I was meeting with who I often saw creating significant wealth, but there was a big difference between the two. And the biggest difference I could come up with was usually the place that they invest, the way that they invest, and the mindset that they invest with. So one was kind of like you're set it and forget it, the traditional world, right? I put money in 4Ks and let the market do the rest. And then on the other side, it's growth opportunities that people just aren't even typically aware of. So we started to really gravitate toward teaching people the value of adding alternative investments to traditional investments. And so we believe that bringing the best of both worlds together is actually what will give people that kind of optimal result. So for me, it's really twofold. One is just my anecdotal evidence. I saw that firsthand. And then the other one was like, if you look up stats, statistic after statistic will show you that the traditional planning model isn't actually getting people where they want to go, and we know because we see every day, people who are post-retirement that are having to go back to work and, not live the lifestyle and really the life that they want to because they're still worried about running out of money and that kind of thing. So anyway, that's a long answer as to how I got to this place. And Blake did it separately. We met probably how long has it been, Blake? How long did you join us? 6 years ago. Okay. So, but you came on your own path.
Yeah, so I've been in the financial services business my entire career, which is about 10 years now. And similar to Christian, I was meeting, originally with people who are at or near the end of getting to the quote unquote retirement space. And a lot of these people had done what the financial media would tell you is everything right. They've maxed out their 4Ks, they paid off their house and debt and things like that. And then they get to kind of the top of the mountain and realized they just weren't going to be able to create the lifestyle that they wanted in retirement, doing it the way that we've kind of been told to do it. So I very much gravitated, like Christian, towards having investments that can create cash flow for you today, be able to build your wealth more significantly. And then part of it, just learn some strategies to kind of optimize how money's moving in and out of investments, some of the strategies that we'll talk about today, and really just kind of fell in love with that space. I love entrepreneurship and business. And some of the tools that we help people with today are really, I think, just allow them to get ahead much more quickly.
I love it, guys. Thank you so much for that introduction. I think it really hits home. But if possible, I want you guys to dive deeper. I want it like at a 5th grade level. I want to really understand. If you're saying everyone is, or these people that you're talking to are doing everything right, They're maxing out their 401ks. They're saving for investments. They're paying off their mortgages. All of these things that traditional finance is saying that you should be doing. Help me understand, how much money are these people making? How much debt did they have? When did they pay it off? Paint me a picture of just, a random case study or a client that comes to mind, Blake, that, hey, this person, when I was working with them 6 years ago in the traditional space, they were doing this and they had challenges versus somebody I'm working with today or a year ago or 2 years ago doing alternatives and how alternatives have actually been that answer that people don't really talk about.
Yeah, sure. So I'm thinking of someone specifically, towards the end of his career, he was about 60 years old when I met him. He was making about $500,000 a year. He had, again, as mentioned, paid off his house, and his primary savings vehicle was, 401ks and other tax deferred vehicles. So they were places that the numbers getting really big because he's not paying taxes going in, it's growing tax deferred. He's loving, what his statement looks like. He ended up with a couple $1,000,000 towards retirement. But then when we started to look at, hey, cash flow planning. So what are you going to be able to take out of this account continually if you want to plan to live for another 30 years? The numbers were very low, especially when you say, hey, now
like what in a ballpark number? If you just threw out a number.
Okay. Yeah. So, kind of the general rule of thumb is what we call the 4% rule. So for every $1 million, you can take, again, there's nuance to this, but you could take about $40,000 a year. So this guy specifically had about a little over $2 million in his qualified account, which turns into $80,000. But again, that's pre-tax, right? So if you take into consideration taxes, you might be just generating 60, 70,000. Now he would have Social Security and stuff on top of that. But all that being said, he was trying to replace a $500,000 income, right? And so to be able to have enough money in this quote unquote accumulation where you're just setting your cash aside, letting it accumulate before you eventually spend it down, which is kind of the traditional financial model. It's very tough to replace a $500,000 income. You would need millions of dollars, right?
I would just call Christian.
Christian.
Yeah, you just called me. I'll write the check. I got you.
But yeah, you're saying, Blake.
Yeah. So, I mean, it just came to a realization of like, hey, there's got to be a better way to do this, right? And so that's where I started to learn about the alternatives. And as opposed to the true accumulation model, where you're just building your assets up for 30 years, hoping there's enough that you can spend it down for the next 30 years. It's like, no, let's take our cash, use it to create cash flow in our life today. And that's a much easier way to build up, to essentially replace your working income, as you continue to build.
I was just going to say, like, one of the things that comes to my mind is just the inefficiency that exists within the model. It's become so difficult to accomplish the exact same thing that you could. So another quick example, right? We lean more toward alternatives because I really don't get a lot of tax benefits by putting money in a qualified plan. In fact, you could argue that I may not get any tax benefit by putting money in a qualified plan. That's all going to depend on the tax rate that I'm in when I put it there and the tax rate that I'm in when I get to retirement, and what's happening with the government in between all that, right? So it's one of those things where when you just do the math for it, I'm so used to doing this with, like Blake said, we so commonly get used to this idea of accumulating a bunch of money. But then when you realize the actual amount that I have to come up with, it becomes a little scary. And that's the other thing that I would say is the biggest difference. It's like scarcity mentality versus abundance. So I get excited about the cash flow model versus the accumulation model because the cash flow model takes care of me better today, but it also continues to build my wealth throughout my retirement. So think about the difference here in mindset. I get to retirement, and instead of just thinking like, okay, how much money can I take before I could potentially run out of money, versus I'm in retirement and I'm going to continue to live off of my cash flow and build my wealth. Like, it's just an entirely different mindset that people have, and it makes a massive, massive difference. What's crazy is most people don't realize it's not even necessarily about how much money you're making. A lot of times it's just about the moves that you're making with the money that you're making.
I agree, Christian. I think both you and Blake dropped a lot of wisdom. So I want to just rewind a little bit, because at one point Blake started dropping formulas, or he started dropping like a way of thinking that I think people aren't aware of, right? He said, you're making a certain income and you have a certain amount of savings. And based off that, he mentioned the 4% rule. So the numbers he used, for example, was, let's say a guy, Mustafa, Chris, Blake, whomever, making 500K. Traditional finance would say you need to 10x that in retirement. So in that example Blake gave, that person should not have 2 million in retirement. They should have 5 million in retirement. So depending on who they're talking to, that person say, hey, you're good, you have 2 million, or hey, you're bad, you don't have 5 million. For me, it's a very simple, bad, you have 5 million, you don't have 5 million. But even if that person had 5 million and they went and they took out 4% every year, which is the rule. And it's like, there's mathematical models, etc., that say if you take out 4% a year, doesn't matter how the stock market is doing, you will be fine. It could be that you take it out in the worst year. It could be that you take it out in the best year. Don't worry about it. You will be fine. That person's taking out 200K pre-tax. So they went from a 500K income to a 200K income. For most people, they're only used to lifestyle inflation. They're not used to lifestyle deflation.
Right.
Losing 300K overnight in terms of your income is hard to swallow. So I think that's the problem with traditional finance. If you look at the numbers, it doesn't really make sense. And no one is there to call it out except you guys at Money Insights to say, hey, it doesn't make sense. And then I loved how Blake, you and Christian analyzed it by saying, we pivoted to alts, to alternatives. And I want you guys to elaborate on what that means, but we pivoted to alternatives to make cash flow today rather than accumulating. And I think that's another thing that really helps people to understand, what is the difference between cash flow and accumulation? What is the difference between traditional investments versus alternative investments? Because I think for a lot of people, we're very good at what we do. And then because we're very good at what we do, we make money. But managing money is its own skill set. And we're not always very good at that.
I'll take one and you can take one, Blake. So cash flow versus accumulation, alternatives versus not. I'll take the alternatives one and I'll let Blake talk about cash flow and accumulation more. So when we're talking about alternatives, we're basically talking about anything that's not stocks, bonds, and mutual funds, right? That could include a wide variety of things. The most common thing that people typically think of next is real estate, but it could be private debt, private credit, private equity. It could be precious metals. It could be cryptocurrency. There's a wide range of what that actually looks like in our mind. But I think the biggest thing is that people just need to get to a place where they're expanding their mindset on what's possible and what's available to them. So a big part of the issue, Mustafa, is that people just, because the noise is so loud and because it's so easy, again, so let's say that maybe you have a client who is the high income tech investor with you, right? So that person making a few $100,000 a year, they just automatically check the box that says, yeah, I'm going to put X amount in my 401k. I know that's the responsible, smart thing to do, when they haven't necessarily analyzed that move to determine, is that actually, one, is that going to save me money? And number two, are there investments there that I think I can really generate the returns that I want and to ultimately help live the life that I want? So a lot of it is just it's just this simplicity in terms of access that gets people stuck into one lane. And our goal, of course, is to help people see that there are other options. Now, I don't want to go down too hard on the traditional space because there are some elements there that are absolutely good. I hate the advisors out there who are telling people not to put money in a 401k that they're going to get a big old match on, right? In situations like that, it's probably hard to overcome the match and make sense of doing something different. But if I'm looking at it head to head and I'm saying, put money in my 401k or start investing it in real estate, whether it's through syndication so that I'm not actively managing it or whether I'm actively managing it, I can generate better returns with less risk and significantly. So it just, to your point, it ultimately comes down to, it just doesn't make sense. But that was a long-winded way of answering the question. Hopefully we got there.
So Blake, before you answer cash flow versus accumulation, I want to double tap on what Chris said. Chris, you alluded to something very briefly about risk. So from your perspective, are alternatives more risky, or is it just that people don't know about them? Help us understand, traditional stock market bonds, CD, etc. versus any of these alternatives, even like life insurance, right? Like help us understand how you would look at risk for alternatives.
Yeah. So when I go to the alternative, obviously it depends on the actual asset. So if we're talking about oil and gas, that may hold going to have more risk associated with it than putting money in my 401k and an S&P 500 account, right? But when you're looking at it holistically, you actually have to look at the underlying investment. So from my perspective, there's not any more risk putting money into real estate. Now, I have to be thoughtful about it, right? But to the extent that I'm thoughtful about how I'm doing it, there's not significantly more risk doing that than I would get from the market. And again, the best way to put it out there is just using the concept of risk adjusted return. And that's so frequently not considered. I know this is such a simple thing, risk adjusted. All it means is that I adjust the actual performance to account for the risk that I'm taking to get there. A lot of times what we'll find, and a lot of the alternative investors like to promote this, but the risk adjusted returns are often better inside in the alternative space, but it's hard to just say one is always better or worse, because if I look at, a CD versus a real estate syndication, then certainly the CD is safer, at least in terms of keeping my money, like the core underlying value safe. Now, if I looked at CDs versus high cash value life insurance, I would now start to say the high cash value life insurance is every bit as safe, if not more safe, just because we're dealing with insurance companies that have been around for 200 years, have an incredible history of paying out. So it really is dependent upon asset class.
Now, Blake, help us understand how this whole conversation connects to cash flow versus accumulation.
Yeah, it's really just, again, a basic framework of the accumulation model is I'm going to pay off everything and I'm going to accumulate money in an account, whether that's for 20, 30, 40, 50 years, until the point where I say, hey, I'm done working, and then I'm going to spend that account down. That's the accumulation model, and hope that I have enough money, really, at the end of the day.
And what happens if you don't have enough money?
Yeah, that's where you get into a little bit of trouble, certainly. That's where you're either living off Social Security, alone. But one of the things, the reasons I didn't like that is it does, and Christian mentioned this, it does create that scarcity mindset. So people who have been building wealth, saving it, all of a sudden when that income is turned off, all they're worried about really is preserving the capital and spending it down as little as possible, because that's a huge fear. Number one fear of retirees is running out of money, right? And no matter how much money you have, you're still going to be concerned about running out. I promise. I've met with enough people that was always their concern.
So you said, the number one concern for retirees is running out of money. And we're in 2025. The last 3 or 4 years, there's been like rampant inflation. Cost of living has gone up a lot. Help me understand, because I don't think retirees today necessarily understand how this is impacting their retirement, or maybe they do. You would have a better pulse on that than I. So help me understand, if I was retired, if I followed this traditional guidance and I had, typically the traditional guidance is like replacing 60 to 80% of your income.
Sure.
Is typically what they're saying.
Yeah.
Which makes no sense to me. Why would I work hard my whole life to then make less money? I don't understand.
I can tell you the idea is they just assume you won't have kids in the house. Your mortgage is no longer there. So because your expenses are down now, but anyone who's lived it or seen it lived many times knows that that's not actually the way that it works.
And we live in a capitalistic society. If I don't have somewhere to spend money, I'll find somewhere new to spend money. Like fundamentally.
No question.
So yeah, help me understand that. And then the cost of living increased as well, right? So, when we're looking at the accumulation model, I think we're all poking different holes from different perspectives, but help me understand fundamentally for the person that did everything right, followed all the conventional wisdom, listened to everyone with that degree from that nice school, etc., and, fancy letters behind their name. They did this accumulation model. Now they've seen everything get much more expensive over the last, 4 or 5 years. Now, how are they approaching this? What can they do to kind of readjust their portfolio, if anything?
Well, I think one of the concerns is, as the money, certainly people didn't expect COVID to be happening, right? And when COVID happened, obviously there was some turbulence in the markets and things like that during that time. But really what it did was open up the money printers even more. And we've seen the value of each dollar go down significantly in the last 5 years, as opposed to maybe what we saw over the 30 or prior to that. So if you get to the point where you've retired, you've got what you've got at that point. And that's why you see the stories about people going back to work, going back to Walmart to be a greeter, right? Because they realize, hey, even if I might have the same amount of income, that income is going to buy me a lot less stuff and not provide for all that I need during retirement. Really, you hope Social Security is enough, but for the people you're working with and people we're talking to, they want a lot more than just what Social Security would provide.
I love that. So now transitioning to cash flow, help us understand what type of mentality that creates, what that looks like, and how that would be impacted by the same 5-year period of inflation, right? Cost of living going up, etc.
Yeah. So one of the things that I like about it is when you start running some numbers and just thinking about it logically, it's very tough to replace a very large income in the accumulation model, which is why you start to see a lot of high income earners transitioning to cash flow model. And cash flow model just says, okay, I'm going to make money, I'm going to save it somewhere, and then I save it there, and then I'm going to deploy it into assets that are going to bring monthly income into my life now. And it's just a much easier way to just start stacking assets, stacking additional cash flows to the point where, hey, I can replace my working income with the cash flow that's being provided from my investments. And then to Christian's point, one of the nice parts, again, depends on what type of alts you're investing in, but oftentimes you're not spending down the principal, right? So you might invest into a real estate syndication, or it could be a car wash, or, a self-storage. There's a million things out there. But you're investing in these, you're creating cash flow now, but you're also not depleting the actual asset, right? You're not depleting your principal. So the principal's still there working for you. You're replacing and you're creating the cash flow now, which as you build that up will help you replace income a lot quicker than, hey, just setting this money aside and hoping it grows over a couple decades.
I love that, Blake. I really appreciate how you touched on where people deploy money to. You touched on real estate, you touched on some other options. Now, if they're deploying into real estate or one of these other strategies, are they making more than the 4% that we alluded to from the stock market? Help us understand what that looks like when we're modeling it out.
Yeah. And so I'm not saying that the stock market is going to get you 4%. That's, historically it's probably in the 8% or so, 10% type of range, depending on what you look at. So when we're talking about the 4%, we're saying you've earned your return, you've got this $1 million or $5 million. What percent can you safely withdraw knowing that the market's going to go up and down? So that's where we get that 4% distribution rate. Whereas when we flip to other assets, we're not necessarily spending down those assets, right? There's other ways to create cash flow in these investments. You're going to both create cash flow in your life today, again, depending on where you're investing, but then you're also going to get the appreciation on that. So you can certainly get higher returns, but you can also then live off those returns without actually spending down your assets, where when you're using the accumulation model, the only way to create cash flow is to actually withdraw funds from those accounts and spend down that asset over time.
I love it, Blake. Thank you so much for slowing down and really clarifying how that all works for the listener. Now, before I do want to circle back to something Christian said, because I thought it was very profound and something that you don't hear often. But before I do, I wanted to say that if you're finding value from this episode, please take a second, hit subscribe, leave us a 5-star review. It really helps more people discover the show. And if you have a friend who might benefit from hearing this conversation, consider sharing it with them too. Now, Christian, you said something that to some people might sound extreme. You said life insurance is safer than CDs. I have my own reason why it might be, but I'm curious to really understand from your perspective, why is that the case?
Well, okay, so I would say the reason that it's the case is because logic speaks that way. Now, what does that mean? Let's just look at where we're getting the backing. So let's say that I'm at a bank, Mustafa, who backs my $250,000. The FDIC does, right? The U.S. government does. How much money does the U.S. government have handy to put out? Now, they have a big fat printer, right? So they could potentially print and, make things more difficult. But when you look at the actual assets, they don't have the assets to back it up. So they're backing it through just the faith and, the faith. What's the wording? I'm trying to get the right word. The faith and something.
Faith in the strength of the dollar?
Yeah. They're backing it through the government is the long and short of it. Whereas insurance companies are a little different, right? A lot different. They actually have to back it with real money. So because of the way that a life insurance company is structured, they have obviously really long-term financial commitments. So what typically happens is they are required to hold excess money when they carry
Reserves?
excess. Reserves.
So
Thank you.
yeah,
Okay, so here's what it looks like. For every dollar that I have with a life insurance company, they're going to have $1.10 or $1.12 or $1.06 or $1.15 in reserves, which means they literally are always sitting on the ability to back it up. Okay, so that's the first reason. The second reason is a little program called Savings and Loans that happened in the 1980s that was also backed by the government, but didn't deliver in the way that people thought of it. So I think that one makes me really nervous. And then we have life insurance companies, which have been around for, some of them 180 years, where they've delivered returns, dividends through the Great Depression, through world wars, through all sorts of market volatility. So they're just like very, very secure. And that's what we love about life. Like, we use life insurance as a secure asset, not as a growth asset. Like, that's not the underlying goal, is to just create growth. What we do is we recommend that people, before they invest, they put the money in the high cash value life insurance policy. And by doing that, we show them how they can actually create a higher overall return on their investments, literally bring back more in return just by doing that. So I know it's kind of, and I pivoted a little bit, but in terms of just sheer strength, I think if people were to just do a little bit of due diligence and research, I won't say that every insurance company is going to be better off, but like the very highest rated ones, there's no question in my mind that they're ultimately safer than what I can get in any bank at this point.
I love that, Christian. Now, I guess, Blake, I have a question for you. I've often heard the statements, as I did my own research, that banks buy life insurance policies. So help me understand, right? I'm putting my money in the bank. The bank, in theory, is investing in things it believes in to make more money, to be able to pay me my 0.04% interest rate. Or maybe I shopped around and I got a 4% interest rate, whatever it is. In theory, the bank is making more money. So is it true that they're buying life insurance? And if so, why?
Yeah, so a lot of them are, and you could Google this, look up, but for your listeners, just search BOLI or bank-owned life insurance, and you're going to see all the big names that you would expect. They buy tons of life insurance. So the way that the banks view these, and even if you fill out an application, you own cash value life insurance, they'll say things like cash or cash equivalent, right? In which case they're talking about high cash value or whole life cash value, and a whole life insurance policy would be a cash equivalent. But the reason that they hold them there, and this was going to what Christian was saying about part of the strategies that we help people implement, is as opposed to storing your money in bank, getting the 0.24, or maybe you got the 4% taxable rate, we can, as individuals, can use the same strategies that the banks are doing. And it's not that we're changing where we're investing, we're just changing where we're storing our cash in between investment deals. So if you're in the alternative investment space, you're probably building up cash somewhere. Typically, people we see using a checking, a savings, a money market type account. Okay, now I've got this deal I'm ready to deploy. You go take the money out of the account, put it in the investment, and as it creates cash flow, it's just going right back into your bank. So the challenge with the bank, yes, you have the safety and you have liquidity, but that's about it. You get no growth in there. There's no tax advantages. It's not really doing a whole lot for you in between deals. As we've talked about with inflation, it's actually losing value simply by just having your money sitting in a bank account. And that's where the cash value life insurance policies can come in. Again, when it's structured correctly, you want to be working with the right company, the right agents who know how to set it up. But all you're doing is shifting where you're storing your capital from bank accounts and just moving it into these high cash value life insurance policies. And you're going to get some significant advantages by doing it that way.
I love that, Blake. I think you said a lot of things that were high value, and I don't think it's possible to really appreciate the value of them, to be honest with you. So I want to take a couple steps back and give you some context, if that's okay. For me, I approach life insurance like it's a scam. I was like, okay, there's two things. There's term life, there's whole life. Whole life is part investment and part insurance products. Fundamentally, why am I paying somebody to manage my money? I can probably grow it faster. So whole life is out. Term life, 90% plus of these policies don't pay out because they lapse or because you reach the term and it expires. So I went on my own long journey of self-discovery. And I think for you, you probably also went on your own journey of self-discovery to eventually be a person that sells life insurance. So if you were to, on an elevator with a fifth grader, trying to explain to them why they need whole life insurance, and within whole life insurance, why they need high cash value versus IUL or some other strategy. Help me understand Kaizen. Help me understand what that conversation would look like.
Yeah. So, I mean, you hit on it. There's people who say life insurance is a scam. And in some ways, if you don't understand why you're doing it, I can understand where they come from. So the traditional idea is this idea of buy term and invest the difference. Whole life is expensive. I can just get term insurance, invest my money, right? And then the term's going to lapse without paying out. Typically, over 99% don't pay out. What we're saying is fundamentally, the insurance is not the investment. So if you're comparing whole life insurance or an IUL to an investment, that's not really the right way to look at it, right? Because insurance has all the qualities of a savings vehicle. So the reason that we're talking about, typically that we'll use whole life for the strategies. Now we do some index universal life insurance strategies as well, but specifically on the whole life side is there's a contractual guaranteed rate that you're going to earn. Typically it's between 2 to 3.75. So often you're earning 3% plus you're earning a dividend if you're with a mutual life insurance company. So after all the cost of insurance is taken out, you can expect to get about a 5% plus, tax-free return. So your money's growing in the policy at about 5% over the long term. And yes, you have the death benefit, but the whole concept here is that you're not at all replacing what you're going to invest in. You're just replacing where you're storing your money in between deals. As opposed to getting nothing or getting a couple percent taxable in a bank, you can get this additional return in the policy. The other main benefit is that you can borrow against your policy. You can take loans against it and literally have your money growing for you in two places.
Why would someone do that?
Yeah, so that's really the key to the strategy. So again, in my bank account example, I have my money in the account. I want to invest. I take the money out of the account. I put it in the investment. I'm getting that rate of return. Now, if you simply change where you're storing your capital from a bank account into a high cash value life insurance policy, again, the structure of the policy is important, but if I'm getting that 5+% return, what the insurance company allows you to do is when you're ready to invest in the same deal you would have invested anyways, as opposed to taking your money out of the account, they basically give you a line of credit. So the insurance company will say, okay, you've got your $250,000 in cash value. We'll give you a loan for $100,000. So you take the insurance company's $100,000, it goes into your bank account and you invest in whatever you were going to do anyways. Now, the big benefit is, yes, I took a loan and I'm going to pay the insurance company an interest rate, but my cash value, my $250,000 remained in that account earning the 5%. I never had to take the $100,000 out, as opposed to only having $150 in my account earning for me. By utilizing the policy loan that the insurance company offers, my $250 continues to grow tax-free, compounding, and I get to invest that money additionally in the real estate or whatever I'm doing in the alternative investment. So very literally, just by putting it through the policy first, we capture a lot of benefits, but the main one being that now when I go to invest, I can literally have my dollars growing for me in two places at once.
That makes sense to me, Blake. But I think sometimes the question that comes up is, isn't taking a loan risky? So help us understand that.
Perfect. And I talk to people who have this concern as well. So the number one thing I would say is there's many different types of loans. Some can be risky. I would argue cash value life insurance loans are absolutely not risky at all. The reason being is, in my example, the only reason that an insurance company will give you a loan is because they have your cash sitting there as collateral. So you might have a loan outstanding on your policy, but even if you did and you called up the insurance company and said, I want out of the deal, the insurance company would say, hey, we have $250,000 of your money. You owe us $100,000. If you want out, we're going to write you a check for $150,000 in that example.
And that would be the surrender cash value, correct?
Exactly. So the cash surrender value less the policy loan. So if you want out of the deal, the insurance company's writing you a check, never the other way around. So yes, there's a loan out there, but it'll either come from the cash value or the death benefit when you pass away. So the insurance
So it's
company
fully
is always
secured.
the one on the hook. Exactly right. And so
Because we already paid. Okay, so that's really helpful, Blake and Christian. And I think you guys have really educated a lot of people on how this works. But let's say for that 1% person who already knew all of this, help me understand what premium finance looks like and if you guys do that.
Yeah, sure. I'll take this one. So we do a lot of premium finance and we have a kind of a unique structure. So first of all, when you say premium finance, what you're saying is instead of me writing the check to the insurance company, I'm going to have a third party write it. Typically a bank is writing it, right? There's a lot of different ways that you can form a premium finance or a premium financed policy. In some situations, it's no cash out of pocket. Maybe you're just paying interest. In our design that we prefer, we actually don't carry outside collateral. So it's all secured within the policy. So it carries a much lower level of risk. Let's put it this way. Let's say that I'm a high income earner, or let's say I have a high net worth or I have a business or something, and I know I want to have $1 million. Let's say it's $10 million worth of insurance, and that's going to cost $500,000 a year to get there. It's going to grow a lot of cash, but it's going to be a pretty high premium, right? So in that situation, I might say, you know what, I can get great returns on my money going and putting those into investments rather than putting that money into the life insurance premium where I can still generate a return, 5% tax free, not bad. But if I can go out and get 15 or 20%, then that still doesn't mesh. So basically, we're doing the inverse of our other concept, right? Now, instead of putting that money to the life insurance company, we're saying, let's have a third party, a bank, put money into that policy for us. That's going to grow. And usually we'll have to participate in some way. But at the end of the day, you're using the strength and growth that exists within life insurance to your benefit. And typically, you've got two benefits that are happening. One, there's a death benefit, right? So if I want to get a large death benefit for a low amount of cash, that's a really good way to do it. It's a way to, and then the other way to do it is the other reason it's really valuable is because it can create incredible tax-free income when it's structured for that purpose. So anyway, we could really deep dive into premium finance. It's maybe an hour-long conversation to get our heads around that fully. But the big thing to remember is I look at it primarily for a high-income earner. It's going to be either an estate planning play or an income play. On the other side, for investments, that's where I typically will run it through what we call the investment optimizer, which is just that. It's just a place, it's the high cash value life insurance. We put money in that optimizes the investments that we're putting into the various places.
I love it, Christian. Thank you. Blake, anything that you wanted to add there?
No, really at the end of the day, what I'd say, when people talk about this idea of life insurance being a scam, or they might not have heard people doing it, keep in mind, you're not changing it out for any investment, right? So life insurance is a tool. It has some very unique characteristics. It has guarantees, it has liquidity, it has growth, it has tax advantages, it has a death benefit. And when you find the way to maximize those benefits and use it in conjunction with your investments, that's really where things start to come to life.
Give me 3 people, what income they're making, how old they are when they should buy life insurance, and what they should be buying. Should they be buying term? Should they be buying, whole life, high cash value? Should they be buying premium? Give me like a succinct one-line story so that somebody listening can say, hey, I kind of fit this bracket. Maybe I need to learn about this product.
Can I just use myself as an example? Because I have a little dabble in all of it. So I'm married. I've got 4 kids, and
how do you have the time to be here right now?
Because you're more fun to talk to
and
than
he's
a baby.
And he's a high income earner. He's a big earner too.
Yes. So I do earn a good income. Okay. So there's a couple of pieces to this. The portion of my assets that I'm eventually going to get into alternative invest, any sort of cash flow investing that I want to do, I'm specifically setting those dollars. I'm putting them into a high cash value whole life insurance policy. I actually own 5 of these policies. So I'm funding the capital into my cash value life insurance policy. And then the money in the cash value is now my opportunity fund for any investment opportunity I want to do. So again, I'm just basically moving the money into the policy before it eventually goes into the investments that I'm going to want to do. Now, when we set up the policies that way, the death benefit is a little bit lower. So like I might have $1 million or $2 million of permanent life insurance. Well, because I'm the only income earner of the house, I've got a bunch of little kids. I also have term insurance as well. So we're not anti-term insurance, because if I were to pass away to replace my income for my wife and kids to live on for 30 years, we're going to need a lot more than $1 million, right? So I also have a big term policy as well. When I'm thinking about the cash value life insurance policies, my goal personally is every dollar that I'm eventually going to put into a cash flowing investment, I'm trying to put into my life insurance policies first. That's my goal. Now, there's some maneuvering around whether that's possible or not, but I want to get as much money into these policies, turn around, borrow against them, put it into a cash flowing asset, create the benefit both in the policy and in the investments. And then whatever I don't have in terms of death benefit coverage that I want, I also have term insurance as well.
Okay, so Christian, I assume you have kids as well. So I'll ask you the questions that I was going to ask Blake. For your kids, are you creating whole life insurance policies for them from day one?
Well, okay, so this is a tricky one because my kids have a little bit of a health issue, but I would if my kids didn't have the health issue. But yes, a lot of our clients do. Blake, do you do that on your kids typically?
Yes, I have policies on each one of my children as well.
Yeah. So
on top of the 5 that you mentioned.
Part of those are those kids as well. Yeah. So
okay, cool.
I keep stacking them up. As more people come around, that's more insured lives.
Okay. Awesome. So yeah, sorry, Christian, you were saying?
Oh, I can't remember. I actually have a lot of policies too, Blake, but mine are on like Rod and me and anyway, so I've got a bunch. But I think the broader point here, a couple of thoughts that I had. I wanted to make sure that I did your initial question justice, Mustafa.
Okay.
Because I do think it's tricky to understand necessarily, okay, depending on what stage of life I'm in, what makes the most sense for me. So I do think if you're 24 years old and you're making, $32,000 a year, you're probably just worried about one thing. And that is, I just want to cover, and I'm assuming you're married, or you know what I mean? So like, if you're just early stage married, you're just getting started, it probably makes sense for you to focus on one thing, and that's just covering your family's need, right? So in that early stage, I would just buy term insurance. Once I got to the place and time where I could actively start saving, that's the point in time where it makes sense to consider using high cash value life insurance. And I would say, like, if you're not at a place where you're at least getting probably 10 grand a year or more, it's probably not super efficient even at that point. So where the time that we typically see people start to move into utilizing this strategy is once they're getting into that kind of 6-figure number. But again, it's less about the actual number, and it's more just about the mentality and determining how I'm actually investing my money, right? So even if I earn $120,000, maybe I only have $5,000 or $10,000 that I can go save. I could go just put that into my 401k. I could put it into a brokerage account. But what we're suggesting is where you'll get the most value is to put it into the policy and find an opportunity from that point on and just funnel it back and forth throughout the life of the policy. This is what's crazy. What you'll find is that 20 years later, 30 years later, if you stacked option A, meaning, okay, I use my bank account as my opportunity fund versus using this high cash value policy, we call it the investment optimizer strategy, as the opportunity fund, I'll have significantly more money just by flowing it through the policy and doing nothing else. It really does depend on the situation. And I never want to say hard, fast, this is the rule. Our typical client, makes probably between $300,000 to $500,000. And, they're pretty serious about investing in alternatives, but you've got to start somewhere. You know what I mean?
Yeah, I think we just lost Christian for a second. But Blake, kind of building on what Christian was saying, for me, if I was making under 100K, it feels like life insurance doesn't make sense. If I'm going to do a life insurance, maybe it's term. And then maybe if I'm in another category, maybe I'm making like 100 to 300K. I'm thinking of something whole life insurance, maybe with high cash value to really optimize it. I think the idea of using it as a bank and bank on yourself type concepts for a lot of people can feel confusing as to why it makes sense. But the general premise of whole life insurance as a savings account, I think a lot of people can get behind. And then with premium finance, I feel like you need a net worth of 5 million. Maybe it's as low as $1 million. I'm curious to kind of hear what your thoughts are.
Yeah, let me hit on the premium finance place, and I'll kind of back up from there. In the traditional premium finance, it was typically for people with over a $10 million net worth. And again, in those structures, the bank is funding all of the premiums, and you have to post significant assets as collateral for that. We've had a model which we call the capital avalanche, where you fund a couple years of premiums, and then we start the bank financing. So it's not all on the bank. And the benefit there is you don't have to post outside collateral. So we have webinars if you want to look into that more, called the capital avalanche strategy. It's a form of premium finance that, you're probably going to want to be in I'd say $2 to $5 million net worth range at a minimum to implement that strategy. But going back to what you were saying about utilizing it as a bank, again, it can sound confusing. At the end of the day, it's really in my opinion, high cash value life insurance is the best opportunity fund for alternative investing. So if you believe in the alternative investing model, you have to build up a pretty big, large amount of capital before you deploy that money into deals, right? So the high cash value policies are just solving the problem of, where do I put my money in between deals that it's going to have some growth, it's going to have some safety, it's going to have some tax advantages, things that we can't always get in a bank account. And then once you start having your money working for you a little more in between deals, the becoming your own bank sort of idea is just this idea that you have access to money via taking a loan, and just understanding that there's ways to have your money growing for you, compounding in your policy, and then paying back a simple interest loan when you take that money to deploy. So at the end of the day, it can sound confusing. I think once you start doing some deep diving, you realize there's tens of thousands of people who are implementing this strategy. I talk to people all the time. They're like, well, why have I not been doing this for the last 20 years? It's like, well, you originally were telling me you thought the whole thing was a scam, and now you're telling all your friends you have to be doing this. So it's just part of the journey that everyone takes.
So when you're on that journey and you're drinking that Kool-Aid, I feel like you get to a point where you're a little confused, because these policies also cost money. So let's say you're opening a $100,000 policy. Let's say you can do a 90% LTV. That doesn't mean that you could access 90K of the 100K. You could probably access maybe 42 to 48K, depending on, how things are all structured. So it can feel like you just lost, 16 grand. Help me understand what that looks like, Blake, if you don't mind.
Great. So let's just take an example of saying someone says, hey, I want the ability to put in 100 grand a year. And again, we can customize.
Which is a big policy for discussion
sure.
purposes.
For sure. We work with people who are doing, 10,000 a year. We also have people putting in multiple 7 figures a year, just so you know. I mean, because once you understand the strategy,
you love it.
So I'm using 100K as an example. All these numbers are scalable. Could be 20K, could be 50K, could be 500K a year, right? These are all things we deal with. Using 100K as an example, if you put 100 grand into the policy in the first year, depending on how it's structured, your age, health, like that, there's a couple variables. You might have 80,000 accessible to you. So your cash value is 80,000. The insurance company will allow you to take a loan to value of typically 95%. So meaning 75,000 of that is available. So if you're in the first year, you're like, I'm losing access to this money. And that's absolutely true. The number one downside to this strategy is in the first couple of years, you're going to have less money available in cash value than what you would have put in. Now you do have the death benefit, but again, the reason we're doing this is for the cash value. The reason that it makes sense is as you continue to fund that policy every year, you'll get to a point maybe in year 3 where you put in $1 and it grows by $1. Meaning I put in 100K, my cash value grows by 100K. By year 10, I put in 100K, my cash value grows by 160 in that year. Meaning it's a very efficient policy. After the first couple of years that I put in $1, my cash value grows by, call it 1.5x what I put in. And that money is immediately available for me to go loan against and go invest, including the opportunity cost of not having the money to invest for the first. You can use it right away, but you're not going to have 100% of the capital in the first couple of years. Put the money in, take a loan against it. There's some opportunity costs in the first couple of years. So if you're someone who's only going to be investing for the next 3 to 5 years, I'd say this is not the strategy for you. If you're someone who's going to be investing for 20 years, you're absolutely going to get further ahead by utilizing this as opposed to the traditional method.
And Blake, I just want to pause you there because I thought that was a very informed response. And I speak to a lot of people about life insurance, and I've been on this journey for several years now, and I've never gotten such an educated response. So I really appreciate it because it helped answer a question that I've grappled with. I think a lot of people have grappled with, and I've just never gotten an answer that really resonated. And I want to tie back to something that we've talked about several times, and we've talked about it like it's not a big deal. We've made the statement, or rather both Blake and Christian have made the statement, when it's structured correctly. Life insurance is great when it's structured correctly. In my humble opinion, 90% plus policies are not structured correctly. So help me understand, when you say something as simple as like, when it's structured correctly, what does that mean for you guys?
Yeah. So if you go to your local State Farm agency or the life insurance agency down the street, not to pick on State Farm, but if you said, hey, I want $1 million of insurance, and they're going to say, all right, here's the cost for term, here's the cost for whole life, right? And basically all of those premiums are going towards the death benefit, right? It's going towards the cost of insurance. It might build a little cash, but it's going to take a really long time. What we do is we meet with investors, talk about their situation, how much money they want to be able to flow into investments each year, build a policy around that. So we're taking the opposite approach. As opposed to how much insurance you want, say how much premium do you want the ability to put in each year? You can choose each year. There's a lot of flexibility with how much you put in. But if you said, hey, I want the ability to put in 100 grand and you're 40-year-old male, well, then what we do is reverse engineer it to say, what's the least amount of insurance, the minimum cost that we can put on these policies? And the reason that we do that is because we want to maximize the cash value growth. So even if you're using the same company, the policy structure can look a lot different. So we say, okay, based on how much you want to put in, what's the minimum insurance that we can put in or on the policy while staying within the IRS guidelines. And we want to stay within those because there's a lot of tax advantages that come with these policies if we stay within those guidelines. And then when we minimize costs, that's going to maximize the growth of the cash value, if that makes sense.
What I would say is I think it's normal for people to kind of feel like interested, curious, but not yet sold. And I think when you're talking to Christian, when you're talking to Blake, when you're talking to me, the goal isn't to really sell someone. It's really to educate and to give people value. Fundamentally, from my perspective, Blake and Christian, this is a product that people don't really understand how it works. And then once you do, it's gold. And then you're wondering, can I just throw more money at it? And so I guess, Blake, that would be another question that I have for you. Right? If somebody's a real estate investor, they built their policy, they're doing 25, 50, 100K a year, and now they're making money from real estate and they're making 200K. Are they then going and buying another policy where they're putting in 200K every year for the next 7 years? Or is it a one pay? What does that look like from your perspective?
Sure. That's a great question. So when we set up those policies, like going back to my example, I said, hey, the max that you want to be able to put in is 100 grand a year. So we build in a lot of flexibility. So we talk about this idea of a funding range, meaning in that policy specifically, you could fund anywhere between maybe 20K to 100K. Now, each year you're deciding on how much you want to put in. But to your point, Mustafa, let's say, life's going well, income's growing, investments are growing. Well, because of those IRS limitations I talked about earlier, you actually, if you want to put 200K a year into it, you need to set up another policy because 100K is the max. If you put more than that, you're going to trigger some negative tax implications. So that's where we stack another policy on. I mentioned I have multiple policies. The reason I do that is because I'm maxed out with where I set it up. Now, the benefit is you can set up the policies originally with however much you want. So the client is the one deciding how much do I want that funding range to be each year. So that's where you start with what makes sense now. As you start to learn the system, implement it, things start to grow. If you want to be able to do more than that, then that's when you're adding another policy. And then to answer your question specifically, we're very rarely ever stopping funding one policy just to fund another. That would be a very rare situation. So typically, we're just going to, once we set up a policy correctly, just keep funding that policy if you want. You don't have to. But yeah, maybe you funded it for a few years and you can just keep funding it. If you want to do more, you would keep funding policy number one and also open up policy number two at that point. Right. So now you're funding two policies as opposed to just the one, but you're not going to stop one just to start another because now you're going back through some of those cost phases that we kind of hit on as well.
I love that, Blake. So let me give you a story and then you can kind of tell me what the right course of action would be. I'm a doctor, engineer, entrepreneur. I'm a person working hard, striving for that American dream. I make 500K a year. I listen to this podcast. I decide to set up a policy and I set it up for 10, 25, 50K, whatever it is. After a couple of years, I see a lot of proof of concept. I'm happy with it. I open another policy for 100K a year. I'm growing, maxing out both policies, etc., and I'm happy with it. And then I'm wondering in the back of my mind, can I be doing it better? And I think a lot of people that I talk to are also of the same mindset. At what point can I take all of these life insurance policies and do like a B or transfer it into like a premium finance type avalanche type product that you alluded to earlier?
Yeah. So I would say first and foremost, if you're only going to let the money sit there and accumulate at the 5%, you're probably not maxing it out. Like no one is coming to us saying, hey, the best rate of return I can get in 5+ % tax free. And that's why I want to set these policies up, right? The reason they're doing it is because they want to earn higher returns in their investments, but also get the 5% in addition to what they're getting in the investment, right? So that would be the first thing. The second thing is once you've set these up, if you get to towards the end of your investing journey, that's where, and you're like, hey, I've got $1 million or so of cash value, and I want to optimize that for retirement income. You could just take the money out of the policy. It all comes out tax-free. Eventually the death benefit pays out the loan that we took in order to get that money out tax-free. So not are your kids being left with a burden, because they're actually being left with an asset after you die. So you got all the tax-free retirement income and your beneficiaries get a benefit. But if you want to really take it to the next level and say, how do I maximize how that money's coming out? That's where we can pivot from using these whole life policies as the investment optimizer, using the cash value to invest. And now we can turn it into a sort of a capital avalanche structure, a premium finance structure, where we say, okay, now we might add another policy, but then have the bank fund these moving forward because we're going to be able to take a lot more tax-free income out of those. So that's one of the nice parts about it I like about our structures. You can kind of pivot as the years go on in terms of what the main purpose of the policies are for you at that time.
I love that, Blake. Again, for everyone, that was Blake, Brogan, and Christian Allen of Money Insights, really diving deep on whole life insurance. A bit of a different format than normal. Normally, I don't go too much into the actual examples, but I feel like with life insurance, it's one of those things that people don't understand. It's one of those things that we all need to invest time in understanding, because when you're on your financial journey, it's all about being efficient. Sometimes there's a faster path. That's the path less traveled. And I think whole life, specifically with a bank on yourself type concept, specifically with a high cash value concept, a lot of people don't hear this. Your financial advisor is typically not talking about this. And it's not to say anything negative about the traditional way finance is approached. It's just to say that fundamentally people in America don't save enough. We're not well prepared for retirement. And if we keep doing the same things, we're going to end up with the same results. Christian and Blake, we will drop your contact information in the show notes. I really enjoyed the perspective and how you challenge the way we think about building wealth. We learned today that financial freedom isn't about grinding harder or hoping your 401k saves you. It's about optimizing, protecting, and intentionally designing a plan that works for your goals, not against them. So here's the challenge for you, the listener. What's the one action you'll take this week to move closer to your financial freedom? Whether it's reviewing your tax strategy, rethinking your investments, or simply defining what generational wealth means to you. Don't wait, take action today. If this episode provides you value, hit subscribe, leave a 5-star rating, and share it with one friend who's ready to play offense with their money. This is MyFinJourney. I'm your host, Mustafa Ladda, signing off until next time.